So what if I told you that the mathematical formulas that govern global wealth aren't just abstract numbers, like they
Mhm.
aren't just sitting quietly on a chalkboard somewhere?
Right, they're not just theoretical.
Exactly. What if instead they are actual physical forces, just like gravity or the wind or friction, and they are constantly invisibly tugging at your money right now as you listen to this?
I mean, realizing that completely changes the way you process the world.
It really does.
Because when you stop seeing finance as this, static spreadsheet and you start seeing it as a dynamic, highly turbulent physical environment, well, the hidden rules of the game suddenly become visible.
And that is the core mission of today's deep dive. We are taking a stack of source material that explores some of our most notoriously mind-bending contradictions in financial engineering.
Specifically, stochastic calculus.
All right, stochastic calculus.
Mm.
And we are going to decode all of it for you. We're walking straight past the dense mathematical symbols, stripping away the dry academic exterior, and replacing those intimidating equations with vivid three-dimensional physical models that you can actually see in your mind's eye.
And we are definitely not doing this as just some, mere theoretical exercise either.
No, absolutely not.
By the time we reach the end of this deep dive, you will understand how a concept you likely learned in high school math is secretly the invisible hand dictating the fate of multi-billion-dollar hedge funds.
Which is wild to think about.
It is, and even more critically, we're going to explore how simply understanding the underlying geometry of money,
The geometry.
right, how that geometry can physically save you from a catastrophic financial wipeout.
So we should just dive right into the core contradiction that sits at the center of modern finance, because this is a paradox that absolutely frustrates seasoned quantitative analysts, and it sets a massive left brain trap for anyone trying to build wealth.
It really is a trap.
So here is the foundational setup. In the classic models of finance, like geometric Brownian motion, we are taught that risk and opportunity expand proportionally to the square root of time.
Right, the square root of t.
Exactly. In math terms, the square root of t. Conceptually, that just means the longer you play the game, the wider the range of possible outcomes becomes.
Ugh.
But there is a massive catch.
A huge catch.
When you look at the actual formula for the long-term return of an asset, the math strictly and violently subtracts a very specific deterministic value from your growth.
Yes.
And that value is 1/2 times the variance multiplied by time, or 1/2 sigma squared dt. The industry calls it volatility drag.
And on its face, that proposition feels completely absurd to anyone who stops to actually think about it.
Right. It feels like the equation just arguing with itself. Like, how can a system that is defined by violent, unpredictable randomness simultaneously create a guaranteed, steady, and perfectly predictable downward pull in your wealth?
Well, the reason it feels paradoxical is because of how human brains are fundamentally wired.
Okay, tell me more about that.
So your left brain, your internal algebraic parser, essentially is desperately trying to use deterministic linear addition and subtraction to make sense of a radically nonlinear random world.
I see.
In traditional high school calculus, if you have a tiny fluctuation, like a little disturbance in a variable, you can usually just ignore the square of that fluctuation.
Because it's so small.
Right, it's considered too small to matter. Think of it like dust settling on a massive shipping scale. You just brush it off because it doesn't change the weight of the cargo.
It's just a rounding error that doesn't impact the final destination.
Exactly, but that's the trap. In the world of stochastic calculus, in the arena of high finance and massive market swings, the volatility is so intense, the fluctuations are so violent that the square of the randomness can no longer be ignored.
It becomes too big.
It literally crystallizes. It solidifies from a state of pure chaos into a tangible, deterministic force that moves forward in time. That is the DT part of the equation.
Wow.
Yeah. And to truly grasp this, you have to force your brain to stop looking at the numbers and switch over to your right brain. You need a fully realized 3D visualization.
Let's build that physical space then. Let's strip away the math for a second and visualize what this actually looks like for the listener.
Okay, we can start with the first half of the paradox.
Yeah.
The square root of time, the square root of t.
Okay.
Imagine you are standing perfectly still in the dead center of a massive, infinitely flat, paved plaza. Now, blindfold yourself.
All right, I'm blindfolded.
Every single second, you take one step, but you choose the direction completely at random. You might step forward, backward, left, or right, dictated entirely by, say, a mental coin flip.
So it's a completely random walk with no memory of the step I took previously.
Exactly that. Now, if I ask someone watching you, Where exactly will they be in 10 minutes? The answer is, well, nobody has any idea.
Right. It could be anywhere.
It is a state of pure uncertainty. However, if we run this exact same experiment a million times with a million different blindfolded people, we will start to notice something incredibly predictable emerging from the chaos.
Which is what?
The average distance of all those people from the center point of the plaza expands outward over time. And it doesn't expand in a straight line. It expands like a growing cloud of fog, slowing down as it gets wider, following the exact square root of time.
Okay. I can picture that fog.
This fog represents your symmetrical risk. You could wander far to the rich side of the plaza or far to the bankrupt side. The fog just tells you how big the realm of possibility has grown.
So the fog represents the chaotic risk spreading out. It's the sheer range of possibilities.
Yeah.
But how does that random spreading fog create a guaranteed downward pull? Like, where does the volatility drag actually come from in this physical space?
That brings us to the second physical model, the curved porcelain plate.
The plate. Okay.
We have to remember that investing isn't just walking around a flat plaza, it's a game of compound interest. It's about proportional growth.
Right.
And compounding is absolutely not a flat surface. It is a geometry that inherently punishes volatility through something called geometric symmetry breaking.
Now, the math on that symmetry breaking is something we really need to highlight, because when I first saw this in the source material, it entirely reframed how I think about investment returns.
It's a game changer.
It sounds complicated, but it's incredibly grounded. So let's say you have exactly $100. You make a really aggressive bet in the market, and you gain 50% in one day.
Nice.
Yeah. 50% of 100 is $50. You now have $150. You're feeling like a genius. But the very next day, the market violently swings the other way, and your portfolio drops by 50%.
A perfectly symmetrical fluctuation in percentage terms.
Right. Up 50%, down 50%. So what is 50% of your new total? That $150 is $75?
Yep.
You subtract that 75, and you are left with exactly $75. You started with 100. The market moved up and down by the exact same proportion, and yet you didn't end up back at break even. You permanently lost 25% of your money.
That invisible thief stealing the 25% is geometric symmetry breaking.
Yeah.
The larger the volatility, the wider the swings, the more brutal that toll booth becomes. Now, map that compounding math back into our 3D physical world.
Okay, back to the plaza.
No, imagine a massive porcelain plate. But instead of being flat, the bottom curves steeply downward like a bowl or a sink.
Got it, a bowl.
Your asset's price is a heavy marble dropped right into this plate. The volatility, that random fog we talked about earlier, is someone picking up the entire plate and shaking it violently side to side.
Just rattling it back and forth unpredictably.
The shaking itself is perfectly symmetrical, left, right, left, right. But because the plate itself is physically curved downward, what happens to the marble?
I mean, it's going to slide down.
Exactly. Every time it gets shaken outward, the curvature of the surface, combined with basic gravity and centrifugal force, causes the marble to slip a little further down the slope. It inevitably settles deeper and deeper into the center of the bowl.
So the shaking itself, the random left and right volatility, is the exact mechanism that generates the downward movement. The chaos is literally creating the gravity.
Yes. The downward pull isn't some external tax collector coming to take a cut. It's generated entirely by the shaking. Without the violent shaking of the square root of time, there is no downward pull of DT.
That's fascinating.
The chaos literally left foot, right foots its way into creating a deterministic tax. It is the chaos stepping on its own toes.
To really synthesize this, I want to bring in an analogy from the sources that makes this incredibly visceral. Imagine you are a high wire walker.
Okay.
You are balancing on a tightrope high in the air between two skyscrapers. The wind is howling around you. That wind, blowing you unpredictably to the left and then to the right, is the square root of T. It's the pure risk, the volatility of the environment.
It's an external force you have absolutely no control over.
Yes, and every single time the wind pushes you left, you have to violently throw your body weight to the right to maintain your balance. Then it pushes you right, and you throw your weight left.
Right.
The wind might perfectly cancel itself out over the course of an hour. Like, it might blow left just as much as it blew right. But what happens to your body? Your stamina is completely draining.
Oh, totally.
The biological energy you are burning to constantly shift your weight and fight the chaos is the DT, the volatility drag. Your stamina drain is 100% guaranteed, even if the wind's net movement is absolute zero.
That's a great way to put it.
Eventually, you don't fall off the wire because a massive gust of wind blew you over.
Mhm.
You fall off because the constant adjustment exhausted your physical energy and you just collapse.
That captures the exhaustion of volatility perfectly, and it brings us to the ultimate takeaway here. This is a phenomenon we can categorize as second-order crystallization.
Second-order crystallization.
When the chaos in a system becomes violent enough, the square of that randomness stops being a theoretical math concept and crystallizes into a physical, deterministic force.
Wow.
In any nonlinear system you interact with, whether it's compounding wealth, managing a complex supply chain, or running a chaotic small business, volatility is not just background noise. Volatility is a physical cost. It imposes a literal geometry tax on your progress.
A geometry tax, that's a brilliant way to frame it. But I have to push back on the shapes we're using here because my left brain is still fighting this setup.
Oh, what's the left brain saying?
Well, you just said that compounding wealth sits inside a downward curving porcelain plate. You explicitly called it a concave shape.
Yeah.
But anyone who has ever looked at a historical chart of compound interest knows it looks like a rocket taking off.
Right.
It curves upward, it starts slow, and then explodes toward the sky. In math, we call that an exponential, convex curve. So why are we describing compounding as a downward concave bowl?
It is the ultimate optical illusion of modern finance, and it traps incredibly smart people all the time.
Really? How so?
You are confusing the physical trajectory of the money with the perception scale of wealth.
Okay, you'll have to break that distinction down for me. How does the physical trajectory differ from the perception scale?
Let's pull apart the illusion. When you look at that rocket ship chart of compound interest, you are looking at the raw physical count of individual dollars.
Okay.
$100 becomes 200, 200 becomes 400, 400 becomes 800. On a regular piece of linear graph paper, the physical distance between 400 and 800 is much larger than the distance between 100 and 200.
Right, the steps get physically taller with every jump.
Exactly. That's why the curve shoots straight up into the air. That is the physical trajectory. But that is absolutely not how wealth actually functions in terms of weight or risk or human perception.
Because doubling your money feels like doubling your money, regardless of whether you are going from $10 to $20 or $1 million to $2 million. The proportional effort is what matters.
Spot on. To make the math fair, to create a universe where the leap from $10 to $20 carries the exact same physical weight as the leap from $100 to $200, we have to pass our numbers through a mathematical mechanism.
And what is that mechanism?
We have to walk through the logarithmic portal. The equation is y equals the natural log of x.
The logarithmic portal. Now we're moving from physical plates into what sounds like science fiction.
The geometry behaves a bit like science fiction, to be honest. Imagine this portal as a massive three-dimensional grid made entirely of rubber bands.
Rubber bands, okay.
At the very bottom of the grid, near zero, the rubber bands are perfectly relaxed and the squares of the grid are wide open and spacious. But as you look higher and higher up the grid, the rubber bands are stretched tighter and tighter and the grid lines are squished immensely close together.
Ah, I can picture that. Spacious at the ground level, but intensely cramped and compressed as you look up toward the ceiling.
Now, launch your compound interest rocket into this rubber band grid. In the normal linear world, the rocket is taking bigger and bigger leaps, accelerating upward. But inside this grid, as the rocket flies into the upper atmosphere, it hits that intensely squished space. Because the grid is compressed exactly in proportion to the rocket's exponential growth, every single time the rocket doubles its money, it moves up by the exact same physical distance on the grid.
I see. So if it doubles from 10 to 20, it moves up, say, exactly 1 inch on our visual grid.
Yep.
And when it doubles from 100 to 200, because that upper space is squeezed so tightly together, the massive dollar amount still only moves the rocket up exactly 1 inch.
Precisely the mechanic at play. The logarithmic portal forces the rocket's path to become perfectly straight. It turns a wild, curving, exponential explosion into a flat, diagonal line climbing steadily upward.
Okay, let me follow that logic and add the volatility back into the picture, because this is where the geometry tax seems to re-enter the equation. We have our rocket, and it's no longer shooting straight up into space. Inside this compressed rubber band grid, it's just drawing a steady diagonal line. But now the rocket starts shaking violently.
It's being thrown off course by the fog.
Right. We have our wind, our volatility. So the rocket drops by 50%. Where does it fall? It falls downward into the lower part of the grid where the rubber bands are completely relaxed and the space is wide open.
Yes.
So a 50% drop registers as a massive long plunge downward on our visual grid. But what happens when it rallies and gains 50%?
That hits the resistance.
Yeah, it has to fight its way upward into the highly compressed, squished ceiling of the grid. So a 50% gain barely moves the needle upward on our visual scale.
You've isolated the exact physical friction.
Wow. A 50% drop is a huge physical plunge through empty space, but a 50% gain is a tiny little hop against the heavy compressed ceiling.
Exactly.
So if the rocket is constantly shaking up and down by 50%, that perfectly straight diagonal line is going to start sagging. The heavy drops will massively outweigh the tiny hops, and the line will physically bow downward.
Yeah.
It sags into a downward-facing bowl. It becomes concave.
That is the exact visual proof of why compound volatility is a fundamentally concave system. The physical money might look like a convex rocket on a bank statement, but the true geometry of the wealth, when adjusted for proportion, is a concave, sagging plate.
That is wild.
It is a scale inversion pattern.
That entirely reframes the intimidation factor of high finance. But, it raises a really foundational, almost philosophical question for me.
What's that?
Why are we doing this? Why force the math through this weird, squished logarithmic portal in the first place? Why can't we just use simple division to calculate our returns? Like, if I have $200 and I started with 100, 200 divided by 100 is 2, I doubled my money. Why isn't division good enough to track my wealth?
That question strikes at the absolute core of how humans and machines, for that matter, process information.
Really?
Yes. The answer lies in the fact that human brains and the CPUs inside our computers are biologically and physically hardwired for addition and subtraction. We think like rulers.
Like rulers?
If I tell you to take 3 steps forward, 2 steps back, and 1 step forward, you can close your eyes and easily visualize exactly where you will end up. It's linear, it's additive.
Right, it's easy to track because the distances never change.
But if I tell you to multiply a line by 1.5, then divide it by 2, then multiply it by 1.1, your working memory completely overloads. You cannot visualize that cascading scale in real time.
No, definitely not.
Multiplication causes exponential explosions in our minds, and in computer processors, it causes what are known as floating point errors.
Oh, I've heard of those.
Yeah, the physical circuits literally run out of memory space to track the cascading decimal places accurately when numbers get too wildly large or too infinitely small.
So the logarithmic portal isn't just a clever math trick. It's an essential translation device for our hardware.
It translates chaotic multiplication into predictable addition. When you pass 1.5 times 0.5 through a logarithm, it becomes the natural log of 1.5 plus the natural log of 0.5.
It changes the operation.
Exactly. It turns a terrifying cascading multiplier into a simple linear ruler that our brains and our microchips can actually read without catching fire.
That makes perfect sense.
And in mathematics, converting multiplication to addition does something even more profound. It resurrects the central limit theorem.
Okay, before we go further, let's make sure we ground the central limit theorem. What does that theorem actually dictate?
The central limit theorem is arguably the holy grail of statistics.
The Holy Grail.
It states that if you add up enough independent random events, they will inevitably form a smooth, predictable bell curve. A normal distribution. Imagine dropping thousands of marbles through a pegboard. They bounce around randomly, but they always form a neat pile in the middle. But here's the catch. It only works for addition.
Wait, really?
If you multiply random events, you don't get a bell curve. You get a chaotic, skewed, unmanageable mess that extends to infinity in one direction.
Because multiplying a tiny error makes it massive.
Yes. So the logarithmic portal transforms the multiplication of compound returns into addition, allowing statisticians and quants to actually predict the shape of the chaos using those familiar bell curves.
Wow.
Without that portal, the entire field of quantitative finance, risk management, and modern portfolio theory simply wouldn't exist. We would be flying completely blind.
That is a phenomenal connection. We use logarithms to trick the math into acting like a ruler, so our brains and our computers can impose order on the chaos.
That's it, exactly.
So we've spent a lot of time in abstract geometry and mathematical portals.
Right.
I want to transition this down to the actual daily decisions a person makes with their money.
Let's do it.
How do we take this knowledge of the geometry tax and these shapes convex rockets and concave plates and spot them out in the real world.
Well, that's where this becomes incredibly actionable for you. You have to train yourself to scan the world for these geometric shapes, because failing to do so is exactly how very smart, very successful people go completely bankrupt.
That sounds intense.
It is.
Yeah.
We can categorize this danger as the expected return trap.
Okay, let's set up a scenario for that trap. Say you were looking at two different investments, and they both advertise a historical average yield of 15%.
Okay.
Your left brain looks at that and says, great, they both make 15%, they are practically identical.
Yeah.
But under the hood, those two assets could have completely different physical engines driving them.
Entirely different engines with entirely different consequences for your future. One could be a life-saving airbag, and the other could be a hidden minefield.
Let's define the first one. Convex systems. This is the airbag.
A convex system is defined mathematically by having strictly limited downside, but completely infinite upside.
Limited downside, infinite upside.
Yes. In the financial markets, a classic example is buying an out-of-the-money call option. You pay $50 for the right to buy a stock at a certain price in the future.
Okay.
If the company goes completely bankrupt, what happens to you?
You lose your $50,
Yeah.
just the premium you paid.
Right. You hit a floor. A solid, unbreakable steel plate. You cannot lose more than your initial $50 bet, no matter how bad the market gets.
Because that's all you put in.
But what if that company suddenly cures a major disease and the stock goes up 10,000%?
Your upside is technically infinite. Your $50 could turn into $50,000.
That is the definition of a convex shape. The downside is entirely flat, but the upside curves aggressively toward the sky. Another profound real-world example is the structure of venture capital.
Oh yeah, VC is a perfect example. Let's put ourselves in the shoes of a venture capitalist. You have a pool of $1 million, and you invest $100,000 into 10 different early-stage startups. Over the next 5 years, 9 of those startups fail completely. They go to zero. You lose exactly $900,000.
Which sounds like a disaster to the average person.
It really does. But the 10th startup turns out to be the next major tech giant, and your $100,000 equity stake turns into $100 million.
Exactly. In a convex system, volatility is your absolute best friend.
You actively want wild, crazy, unpredictable swings in the market because the downward swings hit that steel floor and stop, while the upward swings launch you into the stratosphere.
So the convex system is the airbag. You're fully protected from the crash, but the sky is the limit if things go right.
Now let's look at the exact opposite. What does a concave system look like, the one you call the minefield?
The concave system is defined by having strictly limited upside, but completely infinite, unbounded downside.
But wait, if the upside is capped and the downside is infinite, why would anyone ever agree to participate in that system?
Because the limited upside is usually disguised as a very steady, very reliable, guaranteed payout right up until the exact moment it explodes.
The illusion of safety.
Exactly.
Yeah.
Human beings crave certainty, and concave systems offer the illusion of certainty. In the financial world, a classic example is selling naked put options.
Right.
You collect a small fee up front, say $100 in exchange for promising to buy a stock if it crashes. If the stock stays stable, you keep your $100. It feels like free money.
But if the stock drops to zero, you are legally obligated to buy worthless shares at a massive premium, losing tens of thousands of dollars.
Exactly. You blew yourself up for $100.
Wow.
Another prevalent example that traps regular investors is the guaranteed high-yield structured note. A bank will pitch you a product that promises an 8% return every year, no matter what the stock market does.
That sounds incredibly safe to a retiree.
But if you read the fine print, there is a barrier. If the market drops by more than 30%, the 8% guarantee vanishes, and you instantly absorb the entire loss of the market crash, potentially losing your entire life savings.
So you're trading all of your protective convexity for a measly 8% yield.
Look at the physics of the situation. You are penny pinching on the very edge of a crumbling cliff. You have hit a hard, unbreakable ceiling on your profits. The absolute best you can ever do is that fixed interest rate.
What's your downside?
If a massive volatility event happens, you plunge straight off the cliff into the abyss.
That's terrifying.
Another incredibly common example, one that millions of people participate in without realizing it, is taking on massive leverage to buy real estate.
Okay, walk through the mechanics of that. How is a standard mortgage a concave system?
Let's say you buy a $500,000 investment property. You put down 5%, which is $25,000, and you borrow the other $475,000 from the bank. Your upside on the monthly cash flow is strictly capped at whatever rent you can collect from a tenant minus your massive mortgage payment. Maybe you clear a few $100s a month.
Right, a slow trickle.
But what happens if a local recession hits and the housing market drops by just 20%?
Well, the house is now worth $400,000.
Yes. Your entire $25,000 equity is completely wiped out, and you still owe the bank $75,000 more than the house is even worth. You are financially underwater.
So if I'm holding that $25,000 down payment, I might feel like I'm building wealth. But mathematically, I've bolted myself to a structure that can only ever pay me a fixed trickle of rent, but can financially ruin me overnight if the economic wind blows the wrong way.
In a concave system, volatility is your ultimate enemy. Any violent shaking of the system will inevitably push you off that cliff because the math is weighted entirely against you. The geometry tax comes to collect.
So how do you actually apply this to your own life? It comes down to adopting an anti-fragile life strategy. If you look at your own career and your personal finances, you need to map out your convexity. If you have a capped salary at your job, meaning there is a hard ceiling on how much you can physically earn per year, but you have a massive mortgage, huge fixed expenses, and you are vulnerable to inflation.
Your life is heavily concave.
Right. You are walking on the edge of that cliff every single month, one bad medical bill, one corporate layoff, and you fall into the abyss.
That is a tragically accurate diagnosis of modern financial anxiety. Most people live highly concave lives.
So the cure is to actively inject convexity into your routine. You must seek out convex side bets. You need to find areas in your life where the cost is strictly limited, but the upside is completely uncapped.
Like what?
Learning to write code, starting a YouTube channel, writing a book. The downside is literally just the weekend hours you spent creating it that is your unbreakable steel plate floor. But if the algorithm picks it up, or if a product goes viral, the financial upside is infinite.
Exactly.
You have to balance the concavity of your mandatory bills with the convexity of your creative output.
It is about consciously designing a life where you actually benefit from the chaos and randomness of the world, rather than being constantly terrified of it.
We've established that volatility is a tax on wealth if you are in a concave system, and a massive benefit if you are in a convex system. But as I was reading through the source material, there was this one mathematical revelation that connected everything we've just talked about and boiled it down to one single foundational equation.
Oh, the dual lens principle?
Yes.
Yeah.
Let's talk about the dual lens principle and the high school math reveal.
It all revolves around the foundational equation of financial returns. R sub t equals the natural log of p sub t divided by p sub t minus 1.
Which sounds like a mouthful.
But in plain English, that simply means the return over a given period is the natural log of the current price divided by the previous price.
Okay, that's simple enough.
This one tiny, unassuming equation has two completely different faces, depending entirely on which variable you treat as the independent driver.
Let's define what we mean by the driver.
Think of it as deciding which part of the system is injecting the randomness.
Okay.
Let's look through the first lens. If we decide that the return, the R variable, is the driver, meaning the return is the random independent variable that is shaking back and forth in the environment, and we use it to calculate the final asset price, which is P, the math naturally generates a convex rocket.
Interesting.
Because the random returns are sitting up in the exponent of the formula, the volatility actually boosts the final expected price. The math spits out a positive plus 1/2 sigma squared. It acts as a mathematical bonus.
Because the volatility is happening in the unconstrained realm of the returns, it propels the price upward, just like the venture capital example we just talked about.
Exactly. But now let's flip the lens. What if the physical price P is the driver?
Okay, so the price is shaking.
Right. If the asset price is the thing randomly shaking up and down in the real world, which is how actual stock markets work, and we are trying to use that price to calculate the true composite, return R, the system completely inverts.
It inverts.
Yes. The price has to pass through that squished logarithmic portal we talked about earlier. And because that portal is concave, because the upper atmosphere is squished, it artificially compresses the gains and exaggerates the physical losses. The math generates a concave anchor. It spits out a negative minus 1/2 sigma squared.
The volatility drag. The geometry tax makes its return.
It's the exact same system, just viewed from two different perspectives. But here is the ultimate demystification.
Let's hear it.
We've thrown around terms like stochastic calculus, Ito's lemma, and geometric Brownian motion, but I want to pull off a magic trick right now and prove to you that all this terrifying, complex math is actually just high school algebra in disguise.
Let's break it down. I love a good magic trick.
Do you remember the coin flip game we played earlier? You started with $100, gained 50%, then lost 50%, and painfully ended up with $75.
The geometric symmetry breaking.
Let's look at the two fundamentally different ways to average that outcome. If we take the arithmetic mean, which is just the simple everyday average of the percentages we have a positive 50% and a negative 50%, you add them together, divide by 2, and the arithmetic mean is exactly 0.
Right. Plus 50 minus 50 is 0. The simple average tells me I broke even.
But reality dictates that you didn't break even. You lost 25% of your physical money.
Yes, I ended up with $75.
To find your true compounded average, we have to use the geometric mean. The algebraic formula for that is 1 plus sigma multiplied by 1 minus sigma.
Okay.
If you remember your foundational high school algebra, multiplying a plus b times a minus b, that expands to 1 minus sigma squared.
1 minus sigma squared.
So while the simple arithmetic mean told you the average was 0, the true geometric mean reveals that your wealth actually shrank by the exact square of the volatility.
Oh, wow.
Now, hold that thought and let's go back to our terrifying calculus equation with the logarithm. There is a tool in calculus called a Taylor expansion.
Wait, before we plug numbers into it, what actually is a Taylor expansion? If I'm trying to picture the tool itself, what does it do?
Think of it as a mathematical sculptor.
A sculptor.
Yeah, if you have a really complex, messy curve like a logarithm that is too difficult to calculate precisely, a Taylor expansion lets you approximate that curve using simple, easily calculable tools like straight lines and parabolas.
Yeah.
It's actually how the calculator on your phone computes complex functions. It just runs a polynomial approximation. If you apply a basic second-degree Taylor expansion to our logarithmic return formula, the natural log of 1 plus x, the math elegantly and inevitably simplifies down to an exact formula,
Which is?
x minus 1/2 x squared.
Wait, seriously?
Yes, the x represents your arithmetic average, and the minus 1/2 x squared is the exact mathematical equivalent of the minus sigma squared we just found in the coin flip game.
So you're saying the intimidating math that people get PhDs to understand the Ito correction is ultimately just the reality that a 50% gain and a 50% loss don't cancel each other out.
That is exactly what it is.
That's crazy.
No advanced stochastic calculus is actually required to understand the core mechanism. It is pure foundational logic. It is the mathematical reality that a symmetrical percentage up and down will always result in a net loss.
I'm still wrapping my head around that.
The entire massive field of stochastic calculus is essentially just building a continuous, real-time tracking system for that simple high school algebra rule.
That entirely changes how I look at market fluctuations.
Yeah.
It takes away the intimidation factor. But, I want to pivot the conversation because so far we've established that volatility is a tax if the asset can grow forever.
Right.
We've described geometric Brownian motion as a wild horse running free on a flat plane, where the risk expands forever and the price can theoretically go to infinity.
Yes.
What happens if we apply this geometry to something constrained, like interest rates, where the central bank won't let it run free?
Applying geometric Brownian motion to the wrong asset is a surefire way to fundamentally misunderstand reality. Not everything in the world acts like a wild horse.
So what's the model for the constrained assets?
For constrained assets, we need to introduce a new mathematical framework, which we can visualize as the leashed husky.
The leased husky. I'm picturing a very energetic sled dog that wants to sprint, but it's physically tied to a heavy stake in the ground.
Exactly. In financial mathematics, this is known as the Vasicek model, and it is built entirely on the concept of mean reversion.
Mean reversion.
Think about assets like interest rates or the price of crude oil or even biological metrics like your heart rate. These things cannot go to infinity.
Right. Obviously, my heart rate can't go to infinity.
And if the central bank interest rate compounds like a tech stock and hits 1,000%, society instantly collapses. If the price of oil hits $10,000 a barrel, the global economy grinds to a halt, demand evaporates entirely, and the price inevitably crashes back down.
There is a physical, real-world limit to how high the number can go.
Yes. There is a leash pulling the asset back to a historical, reasonable average. The further the asset tries to run away from that average, the further the husky tries to sprint from the stake, the tighter the leash gets, and the more violently it gets yanked back to the center.
So that's mean reversion.
This is mean reversion. The system constantly corrects itself to maintain equilibrium and prevent destruction.
Okay, the husky on a leash makes perfect sense for things that are forced to stay average. But looking at the world today, like the massive tech monopolies, it doesn't feel like things return to the average. It feels like the winners just keep running further and further away from the pack. Does the math account for a scenario where the leash snaps?
It does, and it enters deeply dangerous territory.
Yeah.
What you were describing happens when you take that Vasicek equation, the equation that represents the leash pulling you back, and you fundamentally flip the mathematical sign.
So instead of the leash pulling you back to the average, being above average acts like a rocket booster pushing you further away.
You have just theoretically outlined the most terrifying force in complex systems. When you flip the signs on mean reversion, you create mean fleeing. Sociologists and economists commonly refer to it as the Matthew effect, taking the phrase from the Bible. To those who have, more will be given.
The ultimate rich get richer formula.
But the physics of it are so much more violent than the simple geometric Brownian motion we discussed earlier. In GBM, the wild horse runs fast and its wealth compounds. It's like a snowball rolling on flat ground. As it gets bigger, it gathers more snow, so it grows steadily.
Right.
But in a flipped mean fleeing model, the snowball is absolutely not rolling on flat ground.
What does the terrain look like?
It is an avalanche rolling down an infinitely steepening spike. The math creates what physicists call a finite time singularity.
A finite time singularity.
In normal compound interest, you have to wait decades to get truly wealthy. In a mean fleeing system, the acceleration compounds on the acceleration. The further you get from the mean, the stronger the physical force pushing you away becomes.
It just feeds on itself.
Exactly. The line goes perfectly vertical in a finite amount of time. It snaps reality.
A finite time singularity sounds like a black hole forming. Where do we actually see this happen in the real world? Because it sounds like a force that would destroy whatever system it touches.
It absolutely does destroy the system, which is why these systems usually end in spectacular, catastrophic crashes or absolute unbreakable monopolies. A classic real-world occurrence is a liquidity black hole, like the exact mechanism that triggered the 2008 global financial crisis.
Walk us through the play-by-play of how 2008 maps to the mean fleeing avalanche.
Let's look at it day by day. Day 1. A major bank holds a massive portfolio of mortgage assets. The price of those assets drops just a tiny bit below the average.
Right.
Because the price drops, the bank's lenders get nervous and demand more collateral, a margin call.
Standard practice.
Right. Day 2. To get the cash to satisfy that margin call, the bank is forced to fire sale some of its assets into the open market. But dumping billions of dollars of assets onto the market creates a massive oversupply, which pushes the market price even lower.
Which pushes the price further away from the mean.
Exactly. Day 3. Because the price dropped even further, the margin calls become vastly more severe, which forces even more aggressive fire sales, which tanks the price further, triggering margin calls at other banks.
It's contagious.
It's a downward avalanche on a steepening spike. Within a matter of weeks, the liquidity of the entire global financial system evaporated into a singularity. The system fled the mean at a hyper-accelerating rate until the gears of global finance completely broke and governments had to step in.
It's the exact same mathematical engine, just pointing straight down into hell. What about an upward trajectory? How does the Matthew effect play out when it points up?
Look at the current tech monopoly AI arms races. Think about the landscape of artificial intelligence right now. You have a handful of massive companies trying to build the best generative model.
Right.
The company that manages to get slightly ahead of the average, the one that releases the slightly better model, suddenly attracts the most users.
And those users are interacting with the AI, which provides fresh data.
Right. The millions of users interacting with the API generate a massive ocean of real-world training data. The company feeds that data back into their servers to make the model exponentially smarter.
So they pull further ahead.
Yes. Because the model is now vastly superior to the competition, it attracts every single user, generating an even larger ocean of data, which makes the model practically omniscient compared to its rivals.
It's unstoppable.
The gap between the leader and the mean doesn't just grow steadily, it explodes into a singularity. The competitors are completely starved of the data they need to catch up, and they die. It is hyperconvexity in action.
That perfectly explains why these markets feel so intensely winner-take-all right now. The math actually forbids a second-place winner once the singularity starts.
Exactly.
And it brings us to the ultimate boss fight of financial mechanics. If we take this mean-fleeing avalanche and map it onto the stock market, we get one of the most famous and chaotic market events of our time, the gamma squeeze.
Oh, the gamma squeeze is the absolute perfect storm of hyperconvexity.
Most people listening will remember the GameStop saga of 2021. The stock went from practically nothing to hundreds of dollars a share in a matter of days, completely bankrupting massive hedge funds.
The legendary event.
The mainstream news kept calling it a short squeeze. But the true underlying mathematical engine of that explosion was a gamma squeeze. How do we connect the theory of mean fleeing to the reality of what happened in those trading rooms?
To understand a gamma squeeze, we have to look for a specific vulnerability in the system. We can call it the forced hedger pattern.
The forced hedger pattern.
In the options market, you have retail investors buying call options. As we discussed earlier, a call option is just a bet that the stock will go up. But for every buyer, there must be a seller.
Right.
On the other side of that trade, you have market makers. These are massive, sophisticated financial institutions whose sole job is to provide liquidity to the market. They're the ones creating and selling the options to the retail investors.
But the market makers aren't in the business of gambling, right? They don't want to take directional risk. They just want to collect a tiny fee on millions of transactions.
That is their entire business model. They want to remain delta neutral.
Delta neutral.
Delta is just the ratio that tells them how much the option price moves when the stock price moves. They want their overall delta to be zero. They don't want to care if the stock goes up or down.
Okay, that makes sense.
But if they sell a massive, unprecedented amount of call options to a horde of retail investors, and the stock price suddenly starts to rise, the market makers are suddenly exposed to massive, theoretically infinite losses.
Because they sold the right to buy the stock at a lower price.
Right. To protect themselves, to force their portfolio back to neutral, they are mathematically required to go into the open market and buy physical shares of the underlying stock.
So they hedge their options exposure by buying the actual stock.
Yeah.
That makes sense.
But here is where the mean fleeing avalanche begins. Driven by a metric called gamma, gamma measures how fast the delta changes. As the stock price crosses a critical threshold, as it gets closer to the strike price of all those millions of options, the gamma spikes, the mathematical models scream at the market makers that their hedge is failing, and they are forced to buy more and more shares to stay neutral.
But what happens when massive institutions start blindly buying millions of shares of a relatively small stock?
Their own buying pressure pushes the price higher.
Exactly. Their forced buying physically drives the price up. But because the price went up, the options are now even closer to being in the money.
The gamma spikes again.
The mathematical models scream, "You are exposed again. Buy more." So they buy more stock, which drives the price up higher, which triggers the models to force them to buy even more.
It's the margin call death spiral from 2008, but in reverse. It's pointing straight up into the stratosphere.
It completely shatters the traditional, smooth, continuous models of finance, like geometric Brownian motion.
Completely.
In GBM, the velocity of the asset is relatively steady. But in a gamma squeeze, you are dealing with acceleration compounding on acceleration. It's not velocity. It's the change in velocity feeding directly back into itself. It is pure, unleashed hyperconvexity. The market makers become a forced mechanical engine of their own destruction, pushing the price away from the mean at an impossible speed.
That's a perfect description of it.
Okay, I follow the feedback loop. But I want to ask a grounded question about how this actually resolves in the real world.
Sure.
In theory, gamma isn't infinite. Right? It peaks when the stock hits the strike price of the option, and then, if the stock goes incredibly high and blows way past that strike price, the gamma should eventually drop back down.
That's what the textbooks say.
Right, shouldn't the squeeze naturally burn itself out once the market makers finish hedging that specific batch of options?
If the world were a static, closed system, you would be 100% right. The gamma would peak, the market makers would hedge, and the fire would naturally run out of oxygen.
But the world isn't static.
No. The real world is intensely dynamic. The real world has a hidden mechanic we can call the matrix relay pattern.
The matrix relay pattern, what's the missing variable?
The missing variable is the psychology of the retail investor. They don't just sit still and watch. Imagine the stock price hits that first massive peak. The retail investors look at their brokerage accounts and realize they just made a fortune. Do they cash out, take their money, and go home?
Bro, The greed kicks in.
Exactly. They take their massive profits and they roll their bets into brand new, even higher strike options.
Oh, wow.
The stock was at $20, it squeezes to $50. The static textbook says the gamma at 50 should go to zero because the event is over. But the retail investors suddenly take their millions in profits and buy a tidal wave of new options at a $100 strike price.
They literally build a new mountain further down the road for the avalanche to hit.
The gamma mountain peak doesn't disappear. It physically moves to the right on the chart. It constantly stays just ahead of the surging price.
That is insane.
The market makers finish hedging the $50 options, breathing a massive sigh of relief that they survived, only to look up and realize that a massive new mountain of $100 options has just materialized out of thin air.
And their algorithms are mathematically forcing them to start the buying frenzy all over again.
Yes, they are caught in an infinite, self-replicating loop of newly spawning landmines. The peak never recedes. It just relays itself further and further into the stratosphere until the clearinghouses step in and the fundamental mechanics of the market completely break.
That is terrifying and fascinating. The static models assume a fixed landscape, but the reality is a dynamic landscape that is actively being constructed right in front of the avalanche to ensure it keeps accelerating.
That is the power of the matrix relay, and that is why a true gamma squeeze can shatter the perceived bounds of financial reality.
What an incredible journey we've been on today.
There really is a lot to take in.
We started by trying to solve a paradox in a mathematical equation. We visualized a spreading fog of risk and a downward curving porcelain plate of compounding wealth to understand the geometry tax.
Right.
We dove through the squished, compressed logarithmic portal to understand why exponential growth is actually a concave trap for our human brains.
We covered a lot of ground.
We really did.
Uh-uh.
We peeled back the terrifying layers of advanced stochastic calculus, only to find a simple high school coin flip hiding underneath the geometric mean, mathematically betraying the arithmetic mean.
The magic trick.
And finally, we watch what happens when a leashed husky breaks free and mean reversion flips into mean fleeing, creating hyper-convex avalanches that shred market makers in an infinite loop of gamma squeezes.
It is a profoundly different way to process the world. It is learning to see the physical geometry hidden beneath the numbers on a screen.
It really is. And I want to leave you with one final provocative concept to mull over as you navigate your week. We touched on this idea of regime switching. Think about your own career, your investments, or the industry you work in. Are you assuming that you are playing a gentle, continuous game of geometric Brownian motion? Are you assuming the wind is just going to blow you a little left, a little right while you steadily walk the wire?
Most people do.
What happens if a hidden variable in your industry crosses a critical threshold and the underlying physics engine instantly snaps? What happens if your world suddenly shifts from a predictable linear walk into a gamma squeeze-style avalanche?
The rules of your reality can change overnight when the regime switches?
They absolutely can. So your mission is to look around your industry and find the forest hedgers. Find the mechanisms, the companies, or the algorithms that are mathematically obligated to buy when things go up or sell when things go down. Map out the convexity and concavity of your daily decisions.
It's vital.
Because when the math stops being abstract numbers and suddenly crystallizes into a physical force, you want to make sure you are the one riding the avalanche and not the one standing at the bottom of the mountain looking up.